Bollinger Bands is a popular technical indicator that uses both a trend indicator and a volatility indicator to make predictions on price movements in the stock market. We're going to go over how to calculate the bands as well as a strategy when using this technical indicator. The Bollinger Bands indicator is comprised of three lines. The line that will be in the middle is the 20-day simple moving average. Up top of the 20-day simple moving average will be an upper band, also known as the resistance band. This band is two standard deviations added to the 20-day simple moving average. And then below the simple moving average will be the lower band. This is known as a support band, which is two standard deviations below the 20-day simple moving average. So here's an example of the Bollinger Bands on the S&P 500. The line in the middle, this is the 20-day simple moving average. This here is the upper band or the resistance band, and here's the lower band, the support band. We're going to begin by doing an example of calculating the simple moving average. Here's the equation for the simple moving average. It is a very easy calculation. Bollinger Bands uses a 20-day simple moving average, which means for every closing price under observation, we're going to add that closing price plus its 20 previous day's closing prices and divide by 20 the number of observations that we're looking at to get our simple moving average for the trading day in question. To better understand this, we're going to calculate the simple moving average as well as the Bollinger Bands for January the 5th, 2020 on the S&P 500. So this value here. Let's begin by calculating the simple moving average of January the 5th. This is the closing price of January the 5th. We're going to add the previous 19 trading days closing prices to this value and then divide by 20. This will give us our simple moving average for January the 5th, which is $3,701.35. That is this point right here. All the points on this line are a 20-day simple moving average of their corresponding trading day. Now that we have our simple moving average line, we'll be able to calculate the upper and lower bands. The upper and lower bands are two standard deviations above and below the 20-day simple moving average. To calculate the upper band, we're going to add two standard deviations to the simple moving average. And to calculate the lower band, we're going to subtract two standard deviations from the simple moving average. Here's the equation for standard deviation. Standard deviation will equal the square root of the sum of all the closing prices, subtract the mean of the closing prices squared divided by the number of observations. So this equation may look like a lot, so let's break it down and look at an example. Okay, some might call this a little excessive, but I believe in giving a full and thorough example. To get the standard deviation, we're going to begin by calculating this here. This is the sum of all the x's, subtract the mean of x squared, divide by the number of observations in question. This is also known as the variance. So to get the variance, we're going to take the mean, and for example in January the 5th, the mean is going to be the simple moving average, which is $3,071.35. So we're going to take the mean, we're going to subtract it by all of its closing prices from January the 5th and its previous 19 trading days, which, if you remember, are these values right here. So we're going to plug those values into here and we're going to subtract the mean, and these are the differences you get here. After we square all the differences, we're going to add them together and divide by 20, as we see here. This will give us our variance, which is 683.84. To get the standard deviation, we're simply just going to take the square root of the variance. So our standard deviation for January the 5th is 26.15. All right, so let's complete our example for January the 5th. We have our simple moving average point for January the 5th, which is $3,701.35. And then we have our standard deviation, which is 26.15. We're going to add 26.15 twice to the simple moving average, and what we get is $3,753.65. That is a point for the upper band of the Bollinger Bands. Then we're going to subtract 26.15 twice from the simple moving average, and that will give us $3,649.05. That is the point for the lower band of the Bollinger Bands. And much like the simple moving average, every point on the upper and lower bands are 2 standard deviations away from their simple moving average. Of course, you don't need to calculate the simple moving average and standard deviations for every trading day to draw your Bollinger Bands. Just simply click on the indicator button, type in Bollinger Bands, click on it, and it'll automatically be calculated for you. So what are the Bollinger Bands trying to tell us? Well, the Bollinger Bands are basically a sideways representation of the bell curve. The bell curve tells us that 34.1% of data is within one standard deviation. If we add and subtract a standard deviation, that will include 68.2% of the data. And if we add and subtract another standard deviation, so 2 standard deviations, that will be 95.4% of the data. So the Bollinger Bands are telling us that 95.4% of the last 20 trading days closing prices are within the upper and lower bands. If a closing price is on the upper band, Bollinger Bands is signaling us to sell, because using the last 20 trading days, there's only a 4.6% chance that the closing price will be above the upper band. If a closing price is on the lower band, Bollinger Bands is signaling us to buy, because using the last 20 trading days, there's only a 4.6% chance the closing price will be below the lower band. Looking at those odds, you may feel very comfortable trading with the upper and lower bands. However, word of caution, Bollinger Bands are not as effective in a trending market. Look at this example of the S&P 500 in February, March of 2020. Clearly, there is a strong downtrend. There are many times where the closing price hits the lower band. Bollinger Bands would have signaled you to buy at this moment. If you followed this, you would have lost a lot of money, as the subsequent sell signal in the upper band was well below the buy signal. The reason that Bollinger Bands is not effective in a trending market is that using the previous 20 trading days isn't an accurate representation of the market when it's moving strongly in one direction. When there are huge price changes and increasing volatility, it is not safe to assume that tomorrow's closing price will fall within the last 20 trading days range. The Bollinger Bands, however, are a very good indicator in a non-trending market. Look at this example from March to July of 2015. The market is not going in one direction. It's going up and down. It doesn't know if it's in a bear or bull market. This is a good time to use the Bollinger Bands. And if you look at this example here, you would have made a healthy profit following the bands. You would have bought low, sell high, then you would have bought low again, and then sell high. So the million-dollar question is, how do you know if you're in a non-trending market? Well, a good way to find out is to use a separate volatility indicator. For this example, I use the average true range. If you don't know what that is, I'm going to provide a link in the description for my video explaining the average true range. In this non-trending market, you can see that there's not a huge steep amount in the average true range. It averages from $11 to $17. So that means on average the price of the S&P is jumping between those ranges. Now let's look at the average true range for March and February of 2020, when there was a strong downtrend. All right, so here is the average true range for February of 2020, March 2020. As you can see, the average true range is a much larger amount than the previous period that we're looking at, ranging from anywhere between $60 at the start of the downtrend to $150. This higher volatility suggests that the market is trending in a direction and makes it unsafe to, in my opinion, to use the Bollinger Bands. Okay, so here's a summary of the strategy that I use for the Bollinger Bands and average true range when trading on the S&P 500. I like to buy when the closing price hits the lower band and the 14-day average true range is below 40. and I like to sell when the closing price hits the upper band and the 14-day average true range is once again below 40. Couple of important points. This is only for the S&P 500. An average true range of 40 may be too high or too low depending on what stock you're looking at. If you're looking at a penny stock, an average true range of 40 is suggesting a really high volatility. It'd be ridiculous to have that volatility for a penny stock that moves up 1 to 2 cents a day. But something like the Dow Jones, where it's trading at somewhere in the 30,000s, 40 might be too low to even make any trades. It might not even hit an average range of 40. So it's important this is only for the S&P 500. And the other important point, this is only for the S&P 500 right now. The S&P 500 is always increasing in price. So this strategy works for right now, but the average true range is going to get larger as the S&P 500 gets larger in price. So this may change in the next couple years or so, depending on what the S&P 500 is selling at.